Today, we will talk about interest rate swaps. An interest rate swap is a contract in which one stream of future interest payments is exchanged for another based on a specific amount. Typically, it involves the exchange of a fixed interest rate for a floating rate or vice versa to manage fluctuations in interest rates or obtain a lower rate of interest. Interest rate swaps involve trading one set of cash flows for another and are customized between two or more parties. They are used when a company can easily borrow money at one type of interest rate but prefers a different type. There are three main types of interest rate swaps: fixed to floating, floating to fixed, and float to float. Each type is used to manage exposure to different types of interest rates. An example of an interest rate swap is when a company needs to raise funds internationally and wants to manage exchange rate fluctuations. They can enter into an agreement to exchange a fixed interest rate for a floating rate to avoid exposure to exchange rate fluctuations. Interest rate swaps are derivative contracts that trade over the counter and can be customized to match the needs of the parties involved. They are often used to exchange fixed-rate payments for floating-rate payments or vice versa to manage exposure to fluctuating interest rates. Here are three key takeaways. 1. Interest rate swaps are forward contracts used to exchange future interest payments based on a specified principal amount. 2. They can be used to exchange fixed or floating rates to manage exposure to fluctuations in interest rates or obtain a lower borrowing rate. 3. Interest rate swaps are sometimes called plain vanilla swaps, as they were the original and often the simplest type of such swap instruments. Hope this would help. Thanks for watching.